Many Dubai property owners are asking the same question. Should I sell my property before the market gets flooded with new supply? You see headlines about thousands of new units coming to the market. You hear people talking about oversupply. You see some investors getting nervous, and naturally, you start wondering, is this the right time to exit? Or would I be making a mistake by selling too early? The truth is, there is no one size fits all answer. Some owners should absolutely consider selling soon. Others should hold confidently, and some should simply monitor the market before making any decisions. So in this video, I'll break down a simple framework to help you understand where your property stands, what risks you should be watching, and how to decide whether to sell, hold, or reposition your investment. Let's start with the most important point. Dubai is not one single real estate market. A villa in Dubai Hills is not the same as a studio in JVC. A waterfront apartment in a limited supply location is not the same as one bedroom in a community where multiple towers are handing over at the same time. So when people say Dubai is oversupplied, the real question should be which Dubai, which community, which property type, because the oversupply risk is not evenly distributed. The biggest pressure is not on every property. It is mainly concentrated in specific areas, specific unit types, and specific communities where large number of similar units are being delivered at the same time. This is why selling just because you saw a headline can be a very expensive mistake. Now, let's talk about supply. Yes, there is a large pipeline of new units scheduled for Dubai over the next few years, but not all announced units are delivered on time. In Dubai, projected handovers and actual handovers are really the same number. Delays are common, construction timelines shift, some projects move slower than expected. So while the headline number might sound dramatic, the real impact depends on how many units actually hand over, when they hand over, and where they are located. But there is one trend that matters a lot. A significant portion of the new supply is concentrated in smaller apartments, studios, and one bed. Why? Because developers know these units are easier to sell. The ticket size is lower, the entry point is more accessible, more investors can buy them. But the demand side is different. A large part of Dubai's end user demand is coming from people relocating with families, professionals upgrading their lifestyle, and residents who need more space. That means two bedrooms, three bedrooms, townhouses, and villas continue to have very different demand profile. So the real issue is not simply too many units, the real issue is a mismatch. Dubai may be building too many of one type of product while still having limited supply in another type of product. And this distinction is exactly what should guide your decision. Now, let's move into a decision framework. To decide whether you should sell or hold, you need to look at two things. Number one, the supply pressure in your community. Is your area receiving a large number of handovers over the next few years? Number two, your asset type. Do you own a small apartment, a larger apartment, a townhouse, or a villa? When you combine these two questions, your strategy becomes much clearer. Scenario one, you own a villa or a townhouse in a low supply community. In this case, your position is generally strong. Established villa communities in Dubai are difficult to replicate. Land is limited, infrastructure is already built, communities are mature, and demand from families remains strong. Think about areas like Dubai Hills, Arabian Ranches, Emirates Living, Jumeirah Gulf Estates, District 1, Jumeirah Park, or other well-established family communities. These are not easy products to replace. A developer cannot simply create another prime villa community in the same location overnight. It takes land, infrastructure, planning, schools, roads, retail, and landscaping, and years of community development. So if you own a good villa or townhouse in a strong community, you are not necessarily exposed to the same oversupply risk as someone holding a small apartment in high density area. For this type of asset, selling should not be a panic decision. You should only sell if you have a clear reason. For example, you want to take profit after strong appreciation. You want to upgrade into a bigger asset. You want to move into a newer launch with stronger future upside, or you want to rebalance your portfolio. But selling only because of market fear, that may not be the best move. Scenario 2. You own an apartment in a low supply or prime location. This is a more balanced situation. If your apartment is in a location with limited future supply, strong lifestyle appeal, or a waterfront positioning, you may still be in a healthy position. Think of areas where land is limited or demand is supported by location, views, lifestyle, or connectivity. For example, certain parts of Palm Jumeirah, Dubai Hills, Creek Harbor, City Walk, Rashid Yachts and Marina, Maritime City, or other well-positioned prime communities. In this case, you do not need to rush, but you do need to monitor. The key indicator to watch is rental yield. If prices continue rising but rent stops growing, your yield starts compressing. That can be an early sign that your property is becoming expensive relative to the income it generates. When yield compresses too much, investors become more selective. And when investors become selective, liquidity can slow down. So, for this type of property, the strategy is hold, but review your numbers every few months. Do not sell blindly, but do not ignore the data either. Scenario 3. You own a villa or a townhouse in a high supply developing community. This is where the answer depends heavily on your timeline. Some developing communities have very strong long term potential, but in the short term, they may face competition because multiple phases are being delivered close together. This can happen in large master communities where many villas, townhouses, and apartments are under construction at the same time. The fundamentals may be good, the community may improve significantly once infrastructure, schools, retail, roads, and amenities are fully delivered. But during the handover period, there can be temporary pressure. More landlords enter the rental market, more sellers list at the same time, buyers suddenly have more options. So if your timeline is 3 to 5 years, holding may still make sense. But if your plan is to sell within the next 12 months, you need to be more careful. In that case, you should look at upcoming handovers in your specific community and ask, will I be competing with many similar units? Are there many motivated sellers? Are rents still rising? Is the community infrastructure improving fast enough to absorb the new supply? Your decision should depend on those answers. Scenario 4. You own a small apartment in a high supply area. This is the category where you need to be the most strategic. Studios and one bedrooms in high density communities are usually the most exposed to oversupply risks. Why? Because many investors bought the same product for the same reason at the same time: lower ticket size, easy rental story, attractive payment plans, higher advertised yields. But when many similar units hand over together, the market becomes very competitive. Tenants have more option, landlords compete on price, sellers compete for buyers' attention, and investors become more sensitive to yield. This does not mean very small apartment is a bad investment, but it does mean you need to be honest about your exit position. If you are already sitting on a good profit and your community has a large number of similar units coming soon, selling earlier may protect your gains. Waiting another year might not always give you a better outcome, especially if rental competition increases and resale listings start rising. So, in this category, the question is not, can the price go higher? The better question is the additional upside worth the extra risk? Sometimes taking profit and moving capital into a stronger asset is the smarter decision. Now, let's talk about off plan properties because the exit timing is different. If your property is still off plan, you usually have three main exit windows. The first window is before handover, when construction is around 70 to 80% complete. At this stage, your buyer is usually another investor. They want something close to ready but still at a discounted compared to fully handover units. The second window is immediately after handover, when the property is brand new and never lived in. This can often be the strongest window because end users are willing to pay a premium for a ready, fresh move in property. The third window is after the property has been rented. At that point, your buyer changes. Now you are mostly selling to investors who will calculate the yield, the tenancy contract, the rent level, and the return. This can still be a good exit, but the pricing logic changes. You are no longer just selling square footage or lifestyle, you are selling income. So if your property is off plan, do not only ask, when can I sell? Ask, which buyer do I want to sell to? An investor before handover, an end user after handover, or a yield focused buyer after renting it. That answer can change your entire exit strategy. Now, before you sell, you also need to calculate the real net return. Many sellers focus only on the headline selling price. They say, I bought for 3 million, now it's worth 6 million. But that is not the number that matters. The number that matters is what you actually keep after all costs. You need to factor in agency commission, NOC fees, outstanding service charges, mortgage clearance costs if applicable, and any other selling related expenses. You also need to prepare your documents early. For example, if you are overseas, do not wait until you find a buyer to arrange your power of attorney. That can delay the transaction and create unnecessary risk. A serious buyer may not wait weeks while you organize paperwork. So if you are considering selling, prepare before listing. Speak to an experienced agent, check your service charge balance, understand your market position, review recent comparable transactions, and calculate your net proceeds before making a decision. Now, let's say you sell. The next question is, what do you do with the money? This is where many investors make another mistake. They sell a good asset, take profit, then leave the money idle without a plan. Selling is only half of the strategy. Reinvesting is the other half. You have three options. Option 1, reinvest in Dubai. This can make sense if you're moving from a high supply asset into a stronger segment. For example, from a small apartment in a crowded area into a villa community, a waterfront asset, a branded residence, or a newer project with better long term fundamentals. The idea is not to exit Dubai, the idea is to reposition inside Dubai. Option 2, repatriate the funds to your home country. This depends on your residency status, your tax situation, and your financial goals. Always check with a qualified tax advisor before making cross border decisions. Option 3, split the capital. You keep part of your money in Dubai for the next investment opportunity, repatriate part of it, and keep a liquidity buffer. This is often the more balanced approach, especially for investors with larger gains. So let's bring this all together. Do not sell because of fear, sell because the numbers make sense. Do not hold because of hope, hold because the fundamentals are strong. The Dubai market is not collapsing, but it is becoming more selective. The next phase will reward investors who understand supply, asset type, location, handover timing, and buyer demand. If you own a villa or a townhouse in a strong community, you may be in a very resilient position. If you own a prime apartment in a limited supply location, hold, but monitor your yields. If you own in a developing high supply community, your timeline matters. And if you own a small apartment in a heavily supplied area, this may be the right time to review your exit options seriously. The best investors do not panic. They reposition. They look at the data. They calculate the net return. They understand the next buyer and they move before the rest of the market is forced to move. So before you decide to sell or hold, ask yourself, is my property in the segment everyone will still want in 5 years? Or is it in the segment everyone else is also trying to exit? The answer will tell you more than any headline ever will. My name is Vanya, and if you want help reviewing your property and understanding whether it makes sense to sell, hold, or reinvest, reach out to me today. I'll see you in the next video.